My name is Thomas Jensen, and I'm working with Treasury and come with a background from corporate Treasury. My focus is on operations and development of the Treasury function through an analytical and digital approach. By my side is my colleague, Nordic.
Thank you, Thomas. I'm Nordic, Thomas's colleague in CFO Advisory, centered in supporting Treasury management functions and operations. My focus is on risk management, hedging using derivatives, and establishing risk policies.
So the concept of Nordic Battle of Treasury is to create a platform that gives you a better understanding of the technological opportunities that can solve your business challenges. Today, we are really excited about having 4 vendors to cover the topic of interest rate risk management. Before we give a background on the topic, I would like to give you some practical information. We have a tight schedule, as always, and to ensure an effective outcome for everyone, hence each of the 4 selected vendors will have 10 minutes to showcase their approach, followed by 5 minutes of questions. I will try to politely interrupt when the 10 minutes or when the 5 minutes have gone, or when the 10 minutes have paused, if and as required. You, the audience, can ask questions via the bar at the bottom of your screen, and we highly encourage you to do that. Nordic and I will handle all questions and try to prioritize them. If you don't get an answer during the session, we'll provide you answers directly following the webinar. And we will share the material to everyone after the webinar as well. Well, Nordic, could you please introduce some background for today's topic of interest rate risk management, which again has become a key important topic for treasurers with the major shift away from the negative or close to zero interest rate regime we have experienced during the last decade or more?
Thank you, Thomas. As you know, interest rate risk management was a big topic in 2022 due to significant changes in geopolitics, which is also expected to be a challenging area to deal in 2023. Interest rates are high. Further central bank hikes are expected due to inflationary pressures because geopolitical war is inflationary. China is opening up, ending zero-COVID policy, which drives global energy consumption significantly. Hence, higher Chinese demand, the higher oil prices. What about the wage price spiral? Do wage increases undermine inflation fight? We bring technology insights from the well-known TMS vendors that support risk management, especially as our NBT topic suggests, interest rate risk management. This is just a sneak peek into some of the possibilities out there to enhance your risk management capabilities, as well as an introduction to some of the most important applications in the space. We hope you enjoy it. Why is interest rate risk management important? As we know, interest rate risk is the risk related to fluctuations in interest rates. Apart from the inverse relationship between the interest rate price and the debt instruments prices, unhedged debt exposures create cash and liquidity problems. When interest rates increase, if it is not hedged, if you have long positions. On the other hand, liquidity problems of the company make refinancing and access to external capital difficult. Most importantly, treasurers' ambition to abide by risk policies and guidelines, which is a key part of the organization, to control adverse effects of interest rate exposures. So here is the framework of the risk management. Overall, we need to abide by the risk policy and guidelines. There are processes where we need to define, measure, manage, and monitor risks, which, to be able to do that effectively, there is a technology plays the most important role. So what do we bring to this webinar? These issues are quite known in the organization, but not so much when it comes to exploiting TMS capabilities in full. We bring insight from the industry by presenting some of the TMS vendors that support the management of interest rate risks. Thomas?
Well, thank you for that brief, Nordic. And before we kick off, I just want to say that to the degree to which the increase in interest rates will impact your organization, obviously it depends on the exposure you have and in which countries and currencies you are represented. We're going to focus today's Nordic Battle of Treasury on how technology vendors can support you in your interest rate risk management. These are good examples of the tech landscape that you will find in the market, and they will cover some of the main themes and questions that organizations like yours face every day. How can they assist you in the transformation of being a business partner to a strategic and value-adding business partner? We will now invite the vendors to the stage, and the order of presentation is Ion, FIS, SAP, and G Treasury. And Ion is the first presenter, and we can welcome Brian to the stage, who will do the presentation.
Thank you so much, Thomas. Thanks so much, Nordic. Hi, everyone. My name is Brian. Hopefully you can hear me okay.
Yeah, that's fine.
Yeah. Perfect. Great. So welcome to today's presentation and webinar. And again, my name is Brian. I head up the solution consulting team here in EMEA for Ion Treasury for the mid-market solution. And today our main focus will be on managing the interest rate risk for corporates. So what's new about managing interest rate risk? As Thomas has mentioned before, and also Nordic has mentioned before as well, the topic of managing interest rate risk has always been there, has always been on Treasury's agenda. But it's become more an increasing important topic to discuss in this moment of time. As you can see probably from the slide, you can see the ECB, the Feds, Bank of England, depending on where jurisdiction you're based in, as well as which currency your company actually holds, these different central banks have all raised the base interest rates in the past year. And you can see probably from the news yesterday, the Feds are probably going to raise the interest rates again. So corporate treasury really now faces some really new challenges, some challenges that we haven't faced for the past 5 to 10 years, which includes, higher interest rates, a high inflation, and also a very high yield for investments as well. And on the contrary side as well, we also have some recent regulations updates, mainly based on IBOR transitions, based on IFRS. How is that going to impact your trades on how they're going to be captured, as well as how they're going to be accounted for as well? So this has certainly reshaped how we should think about managing our treasury risk, as well as more holistically as well, how these challenges will influence your treasury operations, as well as your strategic goals. So today I'm representing Ion Treasury to talk about the key trends and challenges that we have within interest rate risk management. So we have the solution Reval, which can help you with solving some of the problems that you can see here. And you can see, as you're aware, interest rate management is not only a small part of the wider treasury and risk management function, it also overlaps highly with some of the other functions that you're going to perform within your team as well. For example, as you can see, the cash and liquidity, managing your fundings and your debts, the risk management as well, other risk areas, accounting, and so on and so forth. So really, it is a wider topic and then just solely focusing on interest rate risk management. And here are some of the key challenges that we hear and we see from our clients this year on how their treasury face. And we have listed the 4 on the slides here for the key priorities that they're going to solve this particular year. So corporate treasury will need to manage and focus on the debt obligations, making sure that you have enough cash to cover all of your debt obligations. In addition as well, if you have a lot of cash, if you're a cash-rich company as well, how can you leverage the higher interest rates at the higher yield so that you can know how to analyze better on how to invest, where to invest, so that it can give you the strongest return as well. You also need to talk to your counterparties on how to manage your IBOR loans and transition them to ARRs. And then also at the same time, together with the need of hedge accounting as well, to see whether you need to bring hedge accounting into the team altogether or to improve on your hedge accounting process that you currently have. So these are the 4 key challenges that we can see in 2023. And this is kind of a case study that we found from one of the customers when we talked to them and say, what kind of challenges do they kind of face at the moment? And, client X, as you can see here, currently manages the TMS or their interest rate portfolio using an Excel spreadsheet. The key challenges that they face is really that it's become increasingly difficult for them to manage the interest rate risk, as they currently don't have a centralized system that calculates and value all of the trades for them. They also lack a system to help them to generate the hedge effectiveness documentations and also perform the hedge effectiveness calculations. So it is a very manual process for them, and they really need a tool to help them to streamline these pain points, as you can see here on the left-hand side. And what a TMS can really provide you to do and to help you is with the best of breed interest rate risk management solution, whereby we'll help you to automate your end-to-end processes, consolidate all of your exposures, making sure that we provide you with the market data for valuation, the tool that you need to capture any hedges and instruments, as well as to spend more time on the risk analytics side alone. So ultimately, the goal here is really to try to say, I know you have some pain points, let the TMS solve it for you at the enabler, as Nordic and also Thomas mentioned. And then your Treasury team can go from being more of an operational function that focus on a day-to-day task to a more strategic function, whereby you strategize, you plan for any potential risk, and then you spend more time to building your relationship with your banks, with your counterparties, with your auditors, as well as with your TMS vendors. And now that you spend less time on the operational task, I guess a key message that I want to bring out to all the audience here is really what kind of question you should ask yourself. Make sure that you have time to ask the right questions, be strategic about the questions, and also be proactive regards to these questions as well. And here are just kind of the 5 key areas we're going to go over in terms of what kind of questions you can potentially ask within the best of breed interest rate risk management solutions. So for example, instead of asking if you have enough, if your team has valued the interest rate swap correctly, you can now check your interest rate position to see everything has been updated in real time. Is your interest rates positions up to date? You can also leverage a dashboard for monitoring your on-demand valuations as well, making sure that you have all the correct market data to value the trades using industry best practices that are also going to be supported and agreed on by your auditors as well. Also, at the same time as well, as you can see, there are perhaps additional things that a TMS can help on, for example, cash flow forecast and sensitivity analysis. So for example, if you want to just check whether you have any future debt obligations, whether you can or cannot meet them, can I actually predict my cash flow to see how different changes are going to affect my portfolio altogether? And then also to see all of these changes using a graph highlighted in a dashboard so that you can quickly monitor those key changes for you as well. So for example, what's going to happen if LIBOR changes increase by, let's say, 1%, how is that going to impact your entire portfolio? You can have a dashboard and have a key kind of TMS functionality to support that. Moreover, as well, if you have any IBOR linked cash flows, can you actually pinpoint them easily in the system to help you with your IBOR transition task? So again, asking these key questions to say, if you have, any IBOR transition challenges, can your TMS actually just highlight the key pain points for you in order for you to focus on those as your normal operations? From a hedge accounting perspective as well, can your system actually also generate the hedge effectiveness calculations automatically for all of your designated hedges, and then also to automatically generate those portfolio hedges accordingly, your cash flow hedges, your fair value hedges, using all the market data that's available within the TMS itself to help you to perform with all of the calculations. And the ultimate goal here is really to have you and your team to gain a really simplified view of your treasury landscape and to answer the most complex questions of your businesses within the TMS itself, which hopefully, as you can see from the few screenshots that you saw just now, can help you to achieve and help you to evaluate. And with ION, not only we provide you with a TMS, which is, typically the solution that helps you to reduce the manual task and also need to perform on a daily basis on how we enable treasurers to take on a more strategic and analytical role. What we also offer to our clients are what we call value-added services as well. So these services, like our hedge accounting technical task force, which we have a domain area SME groups that helps with any hedge accounting related questions, our IBOR transition assessment services, which help you with your IBOR transitions, our hedge accounting as a services using Reval Center, as well as our day in the life of treasurer, our dialogue function, which provides best practices to all of our clients and using the knowledge and experience that we see from over 1,000 clients and also 50,000 users within our corporate markets in order to help them not only provide them with the solution, but additionally the kind of services that's required so that we can give you our deep industry knowledge to manage your interest rate exposures. So here's the end of my presentation. We're now open to take any questions from the floor, if you have any. I'll pass it back to Thomas and on the back.
Thank you, Brian, for a fantastic presentation. It's impressive that ION can offer so much. There is a question, and you mentioned corporate treasury is a strategic function. What do you see as the next big improvement as a TMS vendor can offer to clients?
Yeah, that's a great question, Nordic. And I think a lot of the customers and clients that we talk to also have similar questions in mind as well. And I think the next big improvement that a TMS can offer is certainly how analytics can come into a role and a more prominent role within the TMS space. So, for example, how can you bring in analytical data from other analytical providers? For example, let's say D-Logic, Accurus, some of the solutions that ION Group itself provides into the TMS tool, so that not only you have the core treasury management systems within your treasury operations, but you're also leveraging some market analytics that can help to drive your funding decisions, help to drive whether you should invest, how to best utilize the cash, all of those kind of good things as well. Those would be the next key challenges that we see.
Thank you, Brian. There's another question as well. You mentioned hedge accounting is as a service. Can you elaborate on what that requires and how your system supports that?
Yeah, certainly. So in terms of hedge accounting as a service, so we do understand that for certain customers, they might not want to perform hedge accounting within their own team themselves. They perhaps not have the expertise themselves, but they still want to execute some trades and then perform hedge accounting on those trades as well. So what we can support within ION is what we call a hedge accounting as service using Reval Center, whereby all you have to do is send in the trades information to us, and we will perform the hedge accounting on your behalf, calculate all the hedge effectiveness, generate the appropriate hedge documentations as well, so that you can submit to your auditors like PwC automatically, and then everyone will be very happy at the end of the day because you have outsourced that service to ION, but then you still have the end product that's produced by ION as well.
Well, thanks a lot, Brian, for a great presentation and for being very timely as well. That's much appreciated. We'll now move on to our second presenter, and we would like to welcome Piotr on stage from FIS.
Yeah, thank you, Thomas. So, hi everyone. My name is Piotr Kieprzewski, and it is my pleasure today to present to you today the FIS solutions that can help you manage your interest rate risk exposures through a market-leading risk management solution. So, just by way of company introduction, at FIS we advance the ways the world pays, banks, and invests by providing financial services and technology to our clients. Now, we're a large company, we're in fintech space, but you may not know that we are also serving some of the biggest Nordic corporates in the treasury and payment space, some of which are probably your peers. Now, After that short introduction of FIS company profile, let's turn to the topic of today. So basically, let me start you by asking, can you recall what you were doing on the 15th of September 2008? So I imagine that it might have been one of the most memorable working weeks in your Treasury career, because that is actually the day when Lehman Brothers filed for bankruptcy. Now, this marked the climax of the financial crisis and was shortly followed by a sharp spike in interest rates, especially LIBOR. Now, after the 2008 financial crisis, like the colleagues before had mentioned, the following decade was actually marked by fairly stable and low interest rates, so interest rate risk management became less of a topic. Now, where we are today, after COVID, after the first years of 2020s, interest rates have become much more volatile, have risen sharply, and even surpassed the levels that we've seen in 2008. So we can basically say that interest rate risk is definitely back on the Treasury agenda. So in today's presentation of the FIS solutions, we'll look at the following steps in the interest rate risk management process. Number one, we want to identify the interest rate risk exposures. Second, we want to hedge the exposures in near real time. And finally, we want to apply the best analytical tools to our portfolio after hedging to evaluate its robustness to potential market movements. And we're going to do all of that based on a simulated interest rate risk management scenario. So let's start by looking at the first step, which is identification of interest rate risk exposures. Now, the features that the FIS solution brings include, first of all, a full portfolio analysis of all Treasury transactions, including the new risk-free rates and the associated benchmarks. Second, very flexible interest rate risk measures aligned to your needs. And finally, live dashboards, so on-demand view of interest rate risk exposures. So, as I said, we're going to look at that, we're going to analyze that for a sample scenario of identifying interest rate risk exposures. So one key contributor to shifts in the interest rate risk is the funding process. So we're going to start here. So what we can see in this chart here is an important KPI in that funding process, which is the working capital forecast used for funding decision making, which in turn impacts interest rate risk. Now, notice that the chart splits the data into operational and Treasury forecasts. And it's worthwhile mentioning that a very reliable and accurate operational forecast is essential to good decision making. For the operational forecast, the FIS solution allows us to actually import the AP/AR data from the ERP in near real time via an API. And note that the forecast is produced using sophisticated artificial intelligence modeling. Within the Treasury forecast, on the other hand, we may find various fixed and floating rate transactions. As an example here, we see a 50 million intercompany deposit that's made to a subsidiary in the US. So moving on to the next step, let's look at the interest rate risk that we're facing now. And we're going to analyze it in this case using a fixed to floating cash flow gap report. So first, notice how the report reflects our desired hedging policy, which in this case we're specifying as a fixed to floating ratio. And it also automatically identifies and highlights where that policy has been violated. So we now have interest rate risk exposures to deal with. And by the way, just note that Quantum allows us to take other perspective at our interest rate risk profile. For instance, we could look at our repricing gaps or interest rate sensitivities such as basis point value. So by now we have seen that the FIS solutions provide you with a sophisticated toolkit to identify interest rate exposures. So by using an FIS solution suite, you will benefit from, first of all, real-time data consolidation supported by AI models, an industry standard suite of models to support wide variety of instruments, swaps, swaptions, futures, trust, options, And finally, a standard package of dashboards to make your decision-making process more sound. So now let's turn to the hedging process. And here within Quantum, what you will find is, number one, ability to implement your hedging policy, as you've already seen, also including the hedging thresholds, hedging proposals with suggested hedging transactions, and finally, hedge accounting with various hedge relationship types, including hedge automation. So turning back to the example that we've been going through, so let's assume here that we want to hedge our risk with an interest rate swap transaction. Note that one special feature about this transaction, that this is a swap that actually has an embedded swaption. And Quantum further allows us to perform an industry standard valuation. It calculates various risk measures, for instance, like highlighted here, the Greeks or transaction duration. And that's for every transaction in our portfolio. Now, finally, we can also conclude by performing a pre-deal limit check. And notice that the interest rate swap does not violate our counterparty limits, so we can proceed with the hedging. Okay, so now, after the limit check, we perform the hedge, which is a 500 million euro one-year float fixed interest rate swap, and we can view our refreshed position right afterwards. And this time we notice that it is meeting our hedging policy. Finally, on the hedge accounting side, the hedge is automatically assigned to a hedge relationship, including the hedge, the exposure, the hypothetical derivative that allows us to perform effectiveness testing. So in this case, you will see that we actually perform the testing using a regression model, but note that we support both the advanced models as well as the simpler ones, such as dollar offset. So to summarize the hedging part of the presentation, note that the benefits that you're getting from our software includes ability to recognize advanced hedging policy rules, including automated notifications for policy breaches. You can benefit from automated dealing, which will reduce your effort and lower your risk of manual errors. And finally, as far as hedge accounting goes, you will be able to meet sophisticated hedge accounting requirements, which will lead to higher quality financial reporting. So as a last step, let's look at post-trade analytics. And for this part, we want to ask ourselves a couple of questions. Number one is, will my hedge, the one that I just made, will it be effective tomorrow? How will it react to changing market conditions? Second, how will the hedge perform when it is stressed? So let's look at modeling some black swan events. And finally, how effective in hindsight was my hedging policy? Let's look at backtesting my hedging policy. So here, what we can start with is scenario definition. So users have the option to define various interest rate scenarios in a user-friendly screen, but they can also use predefined ones that we ship with our solution. And the scenarios can be charted, like you see in the example here. Here, we've just shown a very simple parallel interest curve sheet. Now, after defining the scenarios, let's turn to the scenario analysis. So here, I've defined a scenario called 2008 financial crisis, like we discussed at the beginning of the presentation, and we're trying to replicate the volatility that was present in the market at that time. Now, with the FIS solution suite, this volatility can be effectively managed. So in the first instance, like in the screenshot here, from a P&L perspective, but we also have the ability to assess the liquidity impact on your transaction portfolio. Now, finally, for the more demanding users, they can also benefit from running a value at risk analysis and supplement the scenario analysis. Now, moving to how Quantum can assist you in answering the questions that we asked. First, well, it comes with a user-friendly scenario definitions and analysis. So that allows me to assess how it will react to changing market conditions. Second, when it comes to black swan events, we can use value at risk models, and note that we support various types of models, including historical, variance, covariance, and Monte Carlo. And finally, for the backtesting, it comes with a very rich and flexible reporting suite that allows you to run various reports based on historical data. So to conclude, and recap on what we discussed today. So first, we looked at identifying the interest rate exposures and how they relate to the funding process and various sources of data that are feeding into it. Second, after identifying the exposures, we turned to hedging and looked at FIS Solutions' ability to assist you both in the pre-hedge analysis as well as automating the hedge process, and finally, including the hedge accounting in it. And finally, we asked ourselves some questions about our portfolio's ability to withstand various market events. For that, we looked at such tools as scenario analysis or value risk. So I hope you enjoyed this brief presentation. Look forward to answering your questions. Feel free to contact us for any questions you may have related to this presentation or other solutions. Thank you for your attention.
Thank you, Piotr, for your great presentation. We have some questions. The first one is, you mentioned different measures of IR exposure in your presentation. Can you elaborate on that?
Thanks for that. Yeah, I mentioned some of them, didn't really go into the detail. So the first one I mentioned was fixed floating ratio, and that's one possible measure. So this one simply takes the total expected fixed versus floating interest rate cash flows, and it compares them, right? Typically, it does it by time buckets. Now, second, I mentioned the repricing method, and that looks at the upcoming rate sets or rate resets on a principal basis. And that is when the repricing aspect is when do I have the next upcoming rate reset and how much principal is associated with it. So if we think about the fixed rate assets or liabilities, we would look at their maturity date, whereas for floating, it would be the next rate set date. And finally, I also mentioned interest rate sensitivity analysis, and that focuses on the impact of interest rate shifts. So for instance, how will my portfolio react if the rates shift by 100 basis points? And we can do that by looking either at the fair value impact or liquidity impact, like we mentioned. Now, this is also typically time bucketed, and sometimes we also see it referred as spectrum analysis. So Quantum can also do that. So to conclude the answer to this question, it's common for companies to set limits on based on one of the above measures and basically guide their hedging on that basis.
Yeah, thank you, Piotr. Another question, how do your VAR models help guide decision-making on interest rate risk management?
Thanks for the question.
Could you please answer that?
Yeah. So here, the important bit to mention is that Quantum's value risk models, they provide not just a single VAR number for the entire portfolio, but they also provide a decomposition of that number into, first of all, diversified and undiversified components, as well as FX and interest rate components. So what we see that our clients are typically doing is they do set a limit on the overall VAR number in certain cases and guide their hedging based on that. But they also look at the component VARs, right? So in case of interest rates, they look at the IR component VAR, and that number allows you to understand how much exposure in my portfolio do I have to interest rate risk, especially under these worst case scenarios. So this is how it basically helps inform the IR hedging process.
And then, Piotr, we have just received a question from the audience as well, and that is, you can say, more on a practical level. So, and relating to the system side of it. So all of these functions, they are available in Quantum only, and if not, how straightforward is it then to update integrity to Quantum?
Sure. Thanks for the question. So quantum and integrity are two separate systems here. Our market offerings, typically quantum is for the mid-market and the enterprise market. Integrity is for the lower tier. I would say quantum is definitely the more flexible and the more advanced systems, but a lot of these tools that we've been showing here are also available in integrity.
Well, thanks a lot, Piotr, and now we'll switch to the next presenter.
Thank you.
And I will just see if. Let me just see if. Yeah, that's it. Thanks a lot. So the next presenter is Melania from SAP. Melania, are you ready to go?
Yes, I'm here. I'm not sure if you're also able to see me, but if not, we go.
We do indeed see you.
Okay. Hi, everyone. So I'm Melania from SAP, and I'm so happy to be here with Treasury community. Actually, very glad to be part of it and to be invited as well. So I will get then to SAP story next. So we'll start how customers arrive to SAP. Now with the conditions, you heard a lot on what's happening on the market. We also know the huge push that we have in the digital area on what's going on from that perspective. And then, of course, the customers arrive to us also not only with the how we select exposures, especially when those exposures are generated by the business. We are there knowing the business like no one else. And we capture those exposures and look at those exposures, but also in a holistic way, that those exposures might be generated from different entities, that maybe we also have an intercompany scenario or like a back-to-back trading with a corresponding mirror, or we need to look before we do such an intercompany trade for hedging to take a look at what means natural hedges and then how we calculate that and make sure that we are aligned with the hedging policy, but also take into account all these natural hedges throughout for my entire organization that we are keeping an eye on. And also, of course, then we need to have all these real-time integrated with the banks so that we can flow in real time what happened afterwards. So it's not only that Treasury does something with the trades, but also they need to pay, they have the confirmation, they also have this external trading that now we empowered just from a single cockpit from SAP. Then, of course, all these are happening while considering also cybersecurity topics, identity and access management, and then for sure, some of that audience already rejected banks collaboration just because they did not want it to be on the single cockpit and how to do business with them. So our question is then why would we need to log on into 30 different systems to get to know a robust overview on what's happening in real time with our cash positions, cash flow, and risk, of course. So all this while to be also taking into account of security and also on the collaboration we have with other teams, because the reality is that we need to be close to the business, and what means close to the business is full visibility over entire working capital. So not on our portfolio, but also to what is order to cash, procure to pay, where the business stays, especially when you're doing project hedges, when you want to see the cost of hedges, and then you need this collaboration not only with the cash manager, but also with controllers or other business functions, while you try to keep away as much as possible the unnecessary questions from accounting, from payments team, from all these kind of, and keep it to the minimum while focusing on how can you be acting like a lighthouse for the business. So this is where SAP is like a strong focus that what we consider exposures is native exposures, and we see what business is planning to do and is doing in real time, and we can take actions from there using SAP as a single cockpit. We don't need to get out of the car and see what happened. We are always there, we trigger actions, and then we communicate real time. So this is more like, this is more than integration, it's like an embedded functionality. And we know by now that APIs are not enough if not all these players that you are working with are not signing that this is the standard way and this is how we go together on the innovation path. So now to our interest rate risk management. SAP also looks at this from 3 points of view. One is the selection of the relevant exposures, and we have different dashboards there, and we can see the impact, and we can simulate the deals, and we can see how it would look like with and without the hedges. And of course, is already expected from you to be able to have full visibility on that, to know what to hedge, to see the relationship between it, and also to have the entire life cycle of that process, which is down below in this slide. Then the second point of view is the one where we do this all financial risk calculation. Because of the correlation effects, we need to have this all holistic overview of what we calculate, what we simulate, and see the impact and how would look like my overall managed portfolio. And we will come back to that. And the third point is, of course, the funding and how we use predictive liquidity analytics to support this Treasury as a lighthouse function. So here, of course, it's like one cockpit. Whatever we do with the other teams in the area of any cash event that can come into our attention, to know and to take action from it right away from SAP directly. So then in the area of risk calculations, we also offer this kind of reports that will show as in a click of the button how is the NPVs, how are NPVs with a shift rule. So for example, what happens if we will stress the market data by 500 basis points, how that will affect my entire portfolio, and then with or without the swaps. And then also we see in parallel the NPVs and MPVs with a shift rule. But also we have other calculation here are not all the key figures that we can calculate, but some of the most common ones, for the example, for the duration, to see the average risk of the portfolio. So this is one perspective, but of course we also have all these calculation of value at risk, Monte Carlo, variance, covariance, even backtesting as well. Because because of the correlation effect and because we have this build of the risk hierarchy that includes the interest rate exposure and the FX rate exposure, then we will see that in our value at risk, we will see that maybe with a deal that we want to conclude with even higher our value at risk or not sufficiently lowering our value at risk. And this is super important for these natural hedges, especially when we want to see holistic, how would that impact my entire portfolio, not only for some bits and pieces. And of course, we have different dashboards that would look like, will show that with and without the interest rate swaps. Everything is real time and everything is connected. It's live, even more, it's embedded. And then the third point is what we have in the area of predictive analytics for liquidity, especially. And this is also a step forward that we did in SAP, that we have these predictive results, and then from there the cash manager or the treasurer can directly create a request for a money market or for a fund, and can be reached to the treasurer cockpit, from which one can be released out to a trading platform or to a bank and come back fixed. So everything like a cockpit supporting this cross-team collaboration. So this is the third point, how we are looking at. And in this working capital space, we are not only referring to what comes from cash from a treasury portfolio side, of course, and accounts receivable, accounts payable, but we also have overview on what's happening from inventory perspective in the same dashboard, all these four perspectives. And also for the funding decision, we are not only relying upon banks and funders, but we are also having so-called sub-Taulia platform, for which one we can optimize our working capital via sub-Taulia platform. So with the vendors and customers already there. So that's something new. And of course, all these activities has to be performed and connected so that the treasurer have full visibility on what's going on and would not make actions that won't be suitable or fitted with the real-time current situation of the company, because in the end, it's the risk of the business that you need to keep an eye on, right? So the last point here would be on your road with SAP. We usually start small, of having all these features activated, and you can try on and explore what means embedded, what means to be close to the business, how these dashboards are supporting the treasury decisions, and then of course also how you would look like, how to improve the working capital metrics by these receivable, payables, and overall your liquidity forecast improvements. So that's it from my side. If are any questions?
Thank you, Milena. We have one question. How does your system behave if the underlying interest rate risk exposures are in different currencies? Are the processes interconnected?
Yeah, so that's usually how the customer approaches, because maybe the money market deal or the bond is in a foreign currency, and then of course on one side they cover for the interest rate risk, but on the other side we also need to cover for the FX risk, and this will be immediately shown in the dashboard and will be classified and calculated for both type of risks, and then we would do all accounting and hedge accounting for both going forward, and you will have full visibility on all these processes end to end.
Thanks a lot, Milena, for some great perspectives in your presentation. We will move on. We have had, your picture going forth and back, but the sound was good all along, so no problem in that area. Now we move on to our fourth and final presenter, which comes from Treasury. It's Ruth, and good morning to you, Ruth. The floor is yours, and we are ready to listen in.
Excellent, thank you. Thank you for having me. I have a background in financial statement auditing and hedge accounting, and have specialized in interest rate risk management for the last 15 years. The system that I'm going to be highlighting today is called Capella IR. It's one of the family of Treasury systems. So let me just flip through here for a minute. Okay, so when we think about interest rate risk management, there are really three main areas. There's your risk, and funny how we all come up with three. Slightly different, but three. So we have risk assessment, interest rate strategy, and execution. So here at Treasury, we support clients through an integrated approach of people, processes, and technology. When you think about hedge accounting, one of the most important things you can do is build a super strong foundation. Now, we have consultants or risk advisors that can help you build that strong foundation, assess your risks, identify and agree on risks, then assess them, looking at the economic impacts. I want to pause for a minute on the economic impacts because it's super important that you are starting with the economics and then moving your way across to the hedge accounting, because every now and then we'll come upon a client who has really good hedge accounting. The hedge accounting results are awesome, but the economics behind it are not there. And so they end up increasing the risk for their organization rather than decreasing it. So building a strong foundation is super important. Now, once you have your strong foundation built, then you move over into the analysis and strategy. And this is where a system can really bring a lot of value to you. This is where you can do your analysis ahead of time before you have even traded to figure out, okay, what should I be in and how's it going to react and is it going to be effective, this type of analysis. And again, we have partners who can partner with you at Treasury that will help you with your hedge strategies. They can help you get buy-in from your entire organization. What are your KPIs and your measurements going to be? And really set a strong foundation. The other thing that we do is we do a lot of training. So we do a lot of webinars where you can just sign up and come to the webinar, but then we also do client-specific training to help educate your entire organization on the hedging and the hedge accounting and how it's going to work, help you get board approval. Now, once you've moved through the interest rate strategy, so you've built your foundation, you've done your analysis and your strategy, then you move over here into the execution and managing your program. And again, this is where the system is super powerful. So, just like all the other systems, it's going to do your journal entries, it's going to do your effectiveness testing, your actual hedge designations. It'll do your disclosure tables. It has controls in it, all of this really good stuff. So what I wanted to kind of focus on here, though, is just that to let you know that we really pride ourselves on our flexibility that enables us to match our products and services to your needs. So you can come in anywhere along the timeline here. We have some clients that we just help manage the program, some that we take all the way through the process, some that we just help in the beginning to build the foundation, and that's all they need. So we're available for where you need us. Now, the hedge accounting, Capella's right there in the middle. And we do, again, the designations, the documentation, the valuation, the accounting, and the disclosures. And then we connect up to your other systems to both extract information and then deliver information. So one of the kind of neat things that the system can do is scenario analysis. So the actual day-to-day processing is pretty standard, quite frankly. You have to have it. It's table stakes, we call it. The scenario analysis is something that you can do rate shocks, And you can do this, you can do parallel rate curve shifts, or you can actually change the shape of the curve depending on what you're looking for. And you're the driver in this case. You can do this by financial instrument. You can do it at a portfolio level. You can do volatility shocks and historical trend analysis, impact analysis. I put a couple of just super simple graphs over to the right. The top one is just showing a plus or minus 100 basis point shift, just so that you can, for your disclosures, what did it do to my portfolio? And then on the bottom, we've got a historical trend analysis. This is also a quantitative effectiveness test where we've taken our derivative and we've taken our hypothetical derivative or hedged item and we've modeled them through time to show how they perform. And you can see this one performs. Of course, it's an example. It performs almost perfectly. Funny how examples do that for you. Now, on the debt side, we have all those similar types of shocks you can do. And then what I have up here now is a valuation, a portfolio analysis. And I know it's kind of small. I apologize for that. But the top chart is really showing the SOFR rate curves between December 2021 and December 22, with 21 in orange and 22 in blue, as you might expect. And then the bottom on the left, that chart is showing you the discount rates in the 2 years using the same color coding. So you've got 2021 in orange and 2022 in blue. So what does this do to your portfolio? Well, in this case, we were looking at a fixed rate debt portfolio that had a dirty value of 38 million. So dirty means including interest, of 38 million at the end of 2021. And then when we ended 2022, it had a value of 30 million. So why? Why did it change so much? And how much of that was due to interest rates? And how much of that was really due to what I tend to call the passage of time, because you're actually making payments. Those payments are becoming realized. So that $8 million change is broken down, and 7% of it was due to projected payments that were made. So you realize those payments, you made them, that takes off 7 million. And then the remainder is due to the 13% is due to changes in discount rates. And then that bottom chart is just showing you the discounted cash flows at 2021 in orange, 2022 in blue, and then the bottom kind of gray line is undiscounted. So you can really drill down into your changes, and this could have been a swap, but I just chose a debt portfolio to highlight. But you can really drill down into your changes and explain them in detail, and that will help you bring value to your organization. Now, Capella was designed and tested by our derivative accountants that provide period-end hedge accounting entries to clients all over the world. So we do this for you if you want us to, or you can get in the system and do it yourself. And we have a hybrid where you can get in the system and run reports, and we can still do the hedge accounting for you. One of the neat things that we offer is, if you have a maternity leave, you have somebody unexpectedly leaves your organization, we can jump in and we'll run while you're under stress, and then we'll hand the reins back over. But what I wanted to show here are the modeling nuances. So the modeling nuances, up here now you have a typical swap where you have your fixed leg and your variable leg or your floating leg, and you can put the day counts and calendars in by leg, which makes it super flexible. But as we're moving from LIBOR rates to risk-free rates, we had to get really flexible with our reset options. So, is it in arrears? Is it in advance? What's the averaging type? Is it weighted? Is it simple? Does it have none? Your compounding, your rounding, your rate cutoff, your holidays, your business days, all of this stuff you need to be able to flex, because at least in the United States, what we're seeing is that different counterparties are doing different things with their SOFR rates. Now, once you get all your reset options in there, you need to look at your payment options. So you can have payment delays based on 2 business days after your calculation period ends. And 2 is what I use for an example. It could be any number. Or we have one client who goes from the 1st to the 1st, and they actually pay on the 20th. So you can say it's a specific day of the month. And then you can set your holiday calendars and your accruals by leg and by either calculation or payment or both. Now, the other thing that I wanted to highlight is we have this thing called a complex instrument. It's super powerful because what it allows you to do is take something like a floored swap, which we have a lot of in the United States, particularly floored debt. And I know in Europe you have a lot of floored debt too, even negative floors on that debt sometimes. So you can take the swap and the floor and put them together and get these cash flow reports that have a lot of detail. So up here now is the total. And if you added up the discounted total, you would get, the fair market value of the swap itself. And then you get the fixed leg and the floating leg, fixed on the left, floating on the right. And you can see the actual reset rates on that floating leg. And then you get the floor. So what it allows you to do is take complex instruments and put them together, and then you can do the credit as a single instrument, which is super important. So I know I moved pretty fast. In kind of summary, I just wanted to say we have consulting services, accounting services, the software, which is what I focused on today, and training and education. So again, thank you for having me, and I want to go ahead and open it up for questions.
Thank you, Ruth, for a great presentation, and we have some interesting questions here. So first, you mentioned that software has a lot of nuances. Can you expand on that area a bit?
Yeah, so because it was designed by hedge accountants, it's kind of different. We have a lot of flexibility. So like you can reset monthly on a 3-month index, so 3-month term SOFR, but pay it monthly. And you can actually reset to the 3-month index monthly. The things that we couldn't do in the systems that we started our business in, we designed into our own system. So a lot of flexibility on the modeling, so you can model what you actually have.
Thank you. And a little bit more general question. What types of strategies are your clients using currently in your application?
Yeah, that's a good question. We have all kinds of strategies. What we've seen the most of lately, or kind of what I'm seeing in the US right now, is we've had a lot of cross-currency hedging. We've had a lot of net investment hedging. We've had we're starting to see it's slowing down, but we were doing a lot of future fixed rate debt issuance hedging. And as far as the system, it'll do anything. It can do fair value, it can do cash flow, it can do net investment. This is just kind of what we're seeing on the forefront right now. I'm starting to get inquiries into taking from our larger clients, taking their fixed debt to floating. So all kinds of fun hedge accounting stuff if you're a hedge accounting geek like I am.
Well, thanks a lot, Ruth, for your presentation and your answers. And that completes the entire presentation deck today from our vendors. So thanks to all of you. Yeah.
Thomas, we had a very interesting and great presentation today from different vendors. Before we wrap up today's presentation, we would like to encourage you to digest the following questions and considerations. Are you able to make a complete assessment of how interest movements impact your entire portfolio? How are you able to make scenario analysis and related impact on cash position and M2M values? Are you leveraging your TMS solution to become a strategic business partner? How do your TMS support hedge accounting issues? Yeah.
And then a couple of practicalities. The material will be shared with the audience following the webinar. And in case you have any questions that has not been answered during this webinar, we'll contact you directly. Otherwise, feel free to contact PwC in case you have any questions. And then for our final piece here, that will be a big thank you, and see you next time in Q3. And here we will talk about the importance of big data and the use of sophisticated analytics as a strategic competitive advantage. So thank you once again to the audience, and thank you to our presenters. Thank you.
Thank you very much.